The number one force moving crypto isn't whales, isn't ETFs, and it's not even the SEC. It's the Federal Reserve. And if you don't understand how the Fed works, you're basically trading blind. Welcome back to Captain Altcoin. Today I will explain to you what the Fed actually does, why its decisions move Bitcoin more than any meme narrative, and how I personally approach trading around Fed meetings. Quick reminder, this is not financial advice, just my own research and opinions. If you enjoy content like this, hit that subscribe button and give this video a like. Now let's start with the basics. The Federal Reserve is the central bank of the United States. It sets the cost of money through interest rates and controls liquidity through its balance sheet. You may think you're trading Bitcoin, but really you're trading liquidity, and the Fed owns the tab. How does it make decisions? That's the job of the Federal Open Market Committee, or FOMC. They meet 8 times a year to decide whether to raise or cut rates, expand or shrink the Fed's balance sheet, or signal a pivot. Each meeting shakes global markets, sometimes even before it happens. In my mind, the most important thing to understand is their dual mandate: price stability and maximum employment. When inflation runs too hot, they raise rates. When job growth slows, they ease. Every move is a balancing act. And if you can figure out which side of that balance they care about most, at any moment, you can front-run their decisions. But here's the catch. The rate number itself often doesn't move markets. It's Powell's tone, the dot plot, and forward guidance that matter. Markets usually price is the actual decision ahead of time. What traders react to is whether Powell sounds hawkish or dovish compared to expectations. In my opinion, this is where most retail gets caught off guard. Now let's move to why this matters for crypto. Bitcoin and altcoins are risk-on, liquidity-sensitive assets. When the Fed eases, money rotates into risk assets and crypto rallies. When the Fed tightens, liquidity drains and crypto bleeds. Every single bull run in Bitcoin history has followed an easing cycle, and every brutal drawdown lined up with tightening. Macro, memes, liquidity, narratives. And we can see this in real time. Bitcoin is at around 112,000 right now. The Fed just cut rates, but the price barely moved. Why? Because the cut itself was already priced in. What markets are waiting for is Powell's tone and forward guidance. That's what will decide whether Bitcoin grinds higher from here or risks another pullback. So, how does it usually play out around an FOMC meeting? Here's the pattern I've seen again and again. Bitcoin trades sideways or even drifts higher into the meeting. Funding rates flip long. Then whales and market makers dump into thin liquidity. Longs get liquidated, cascading sell-offs trigger. Finally, the Fed announces a rate move as expected. Volatility spikes, then fades, and the market either rebounds or continues trending. It's almost like clockwork. What tools can you actually use to crack the Fed like a pro? In my view, there are few essentials. The CME FedWatch tool tells you market odds of hikes or cuts. Bond yields, especially the 2-year and 10-year, show what the market expects. The DXY, the US dollar index, is a leading macro indicator. Rising DXY means flights to safety. Falling DXY means risk appetite returns. And don't ignore the Fed's balance sheet or reverse repo flows. That's the hidden liquidity engine that actually fuels rallies. In my mind, this all boils down to one thing. You don't need to become a macro economist, but you can't afford to be a macro illiterate. If you ignore the Fed, you're not a trader. You're the liquidity for smarter money. So here's how I personally trade around Fed events. I watch expectations first. If the market already prices in a cut, I don't gamble on the number. I position for volatility instead. Usually that means avoiding leverage right before the meeting. Then I listen to Powell's tone. If it's dovish, I look for entries on dips because liquidity is likely coming back. If it's hawkish, I protect capital because risk assets will bleed. That's how I see it. The Fed sets the rules of the game, and if you don't learn to play by those rules, you'll keep getting wrecked when liquidity shifts. What about you? Do you watch Powell's tone or do you trade purely on charts? Drop your thoughts in the comments. Thank you for watching and see you soon. This is Captain Altcoin signing off.